If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge. And when we help others grow, we grow too. Thank you so much for listening. Let's dive into the audiobook. Chapter 1, The Wisdom of Wise Investing. Part 1, The Safety Net, Why Diversification Matters. When Intel stock plummeted 90% during the dot-com crash. Countless employees who had poured their retirement savings into company shares watched decades of careful planning evaporate overnight. Meanwhile, diversified investors experienced bruises rather than devastation, their portfolios cushioned by bonds, international stocks, and other assets that held their ground. Picture your investment portfolio as a restaurant menu. If you only serve hamburgers and beef prices skyrocket, you're in trouble. But if you offer chicken, fish, pasta, and salads, rising beef costs become manageable because customers can choose alternatives. Your kitchen keeps running regardless of supply chain disruptions affecting any single ingredient. Benjamin Graham understood this principle deeply. The father of value investing preached that diversification serves as your most reliable protection against the market's unpredictable nature. Graham witnessed the 1929 crash destroy fortunes built on single stocks and narrow sectors. He saw brilliant investors reduced to ruin because they concentrated their bets, believing they could outsmart the market's volatility. History repeatedly validates Graham's wisdom. During the 2008 financial crisis, those who owned only bank stocks faced catastrophic losses. Washington Mutual, Lehman Brothers, and Bear Stearns shareholders lost everything. Yet investors holding diversified portfolios containing government bonds, healthcare stocks, and consumer staples weathered the storm far better. Their losses were real but recoverable. The mathematics behind diversification work in your favor. When technology stocks crater, utility companies often remain stable. When domestic markets struggle, international opportunities may flourish. Real estate investment trusts can provide income when growth stocks disappoint. This isn't about predicting winners and losers. It's about acknowledging that prediction itself is impossible. Consider the contrasting stories of two investors in 2000. Sarah concentrated her entire 401k in Enron stock, believing in the company's innovative energy trading model. By 2001, she had lost her retirement savings completely. Meanwhile, David spread his investments across a total stock market index fund, international funds, and bond funds. When Enron collapsed, his portfolio barely noticed because Enron represented less than 1% of his holdings. John Bogle revolutionized investing by making diversification accessible through index funds. His research showed that owning thousands of companies through broad market funds delivered better returns than trying to pick individual winners. The Vanguard 500 Index Fund, launched in 1976, gave ordinary investors the same diversification previously available only to institutions. Modern research confirms what Graham and Bogle preached. Nobel Prize winner Harry Markowitz demonstrated mathematically that diversified portfolios reduce risk without sacrificing returns. His work proved that combining assets with different performance patterns creates portfolios more stable than their individual components. The beauty of diversification lies in its simplicity. You don't need complex formulas or market timing skills. You just need patience to let different investments balance each other over time. When some zig, others zag, creating the steady upward progression that builds lasting wealth. Smart diversification transforms investing from gambling into systematic wealth building. It replaces anxiety with confidence, knowing that no single investment can destroy your financial future. Part 2. Lessons from the Masters. Timeless investing principles. When Benjamin Graham lost nearly everything in the 1929 stock market crash, he discovered something that would reshape investment philosophy forever. The father of value investing realized that survival, not spectacular gains, was the true measure of investment wisdom. This painful lesson birthed principles that legendary investors still follow today. Warren Buffett calls Graham his intellectual father for good reason. Graham's core insight was revolutionary yet simple. Successful investing requires discipline over emotion, patience over speed, and systematic thinking over gut instinct. After watching fortunes vanish overnight during the Great Depression, Graham developed rules that protected wealth first and grew it second. Consider Graham's famous margin of safety principle. He taught investors to buy assets trading below their intrinsic value, creating a cushion against mistakes and market volatility. This wasn't about finding perfect investments, but about building portfolios that could survive imperfect conditions. Graham understood that markets would always cycle between extremes, and smart investors position themselves to benefit from this reality rather than fight it. John Bogle took these lessons and democratized them through index investing. When Bogle founded Vanguard in 1975, Wall Street dismissed his idea of passively tracking market indices as mediocre. Yet Bogle's simple philosophy produced extraordinary results. His first index fund, initially mocked as Bogle's folly, proved that low-cost, broadly diversified investing consistently outperformed expensive, actively managed alternatives. Bogle's genius lay in recognizing what Graham had discovered decades earlier. Most investors are their own worst enemies. They chase hot stocks, panic during downturns, and pay excessive fees that erode returns. Bogle's solution was elegantly simple. Own everything through diversified index funds and let compound growth work its magic over time. Warren Buffett validates this approach through his own investment philosophy. Despite being history's most successful stock picker, Buffett recommends index funds for most investors. His famous bet with hedge fund manager Ted Seides proved this point dramatically. Over 10 years ending in 2017, a simple S&P 500 index fund outperformed a carefully selected portfolio of hedge funds, even after accounting for fees. The timeless wisdom from these masters centers on three unshakable principles. First, stay diversified across multiple investments and asset classes. Second, keep costs low because fees compound against you over time. Third, maintain discipline during both euphoric bull markets and terrifying bear markets. These lessons feel almost boring compared to today's investment fads. Cryptocurrency speculation, day trading apps, and get-rich-quick schemes. Yet boring works. Graham survived the Depression, Bogle revolutionized investing for ordinary Americans, and Buffett became the world's most respected investor by following these same fundamental principles. The real secret isn't discovering some hidden investment strategy. It's having the discipline to stick with proven approaches when everyone else is chasing the latest trend. That's the ultimate lesson from the masters. Consistent application of simple principles beats brilliant analysis of complex strategies every single time. Part 3. The magic of spreading your eggs. Simple ways to lower risk. When IBM ruled the computer world in the 1970s, owning its stock seemed like a guaranteed path to riches. The company dominated every corner of the technology landscape, and analysts declared it virtually invincible. Yet by the 1990s, IBM shareholders had watched their fortunes evaporate as personal computers disrupted the mainframe business model. This painful lesson teaches us something profound about risk management that goes far beyond picking winning stocks. The mathematics of diversification work like a simple insurance policy. When you spread your money across different types of investments, you create a buffer against the inevitable surprises that markets deliver. Consider what happened during the 2000 dot-com crash. The Nasdaq Technology Index plummeted 78% from peak to trough, wiping out trillions in wealth. But investors who owned bonds, international stocks, and value companies experienced much gentler declines. Their diversified portfolios acted like shock absorbers, cushioning the impact of the tech sector's collapse. Think of diversification as building a financial ecosystem rather than betting on individual stars. A healthy forest contains oak trees, pine trees, wildflowers, and countless other species. When disease strikes the oaks, the pines continue growing. When drought affects shallow-rooted plants, deep-rooted trees survive. Your investment portfolio benefits from this same principle. Stocks provide growth potential, bonds offer stability and income, and real estate investment trusts give exposure to property markets. Geographic diversification adds another layer of protection. During Japan's devastating bear market of the 1990s, Japanese stocks lost 60% of their value over the decade. Meanwhile, American stocks tripled. Investors who owned both markets saw their losses from Japan partially offset by gains from America. No single country dominates economic growth forever, and spreading investments globally captures opportunities wherever they emerge. Industry diversification proves equally powerful. Energy stocks soared during the 1970s oil crisis, while manufacturing companies struggled. Technology dominated the 2010s, while utilities lagged behind. Healthcare companies often thrive during economic uncertainty when people still need medical care. By owning companies from various sectors, you avoid the catastrophic risk of betting everything on one industry's fortune. The beauty of this approach lies in its simplicity. You don't need to predict which investments will outperform. Instead, you accept that different assets will lead at different times. When stocks stumble, bonds might rally. When domestic markets struggle, international investments could flourish. This strategy transforms investing from gambling on specific outcomes into participating in the broader growth of human economic activity. Even small amounts of diversification create meaningful risk reduction. Research by Harry Markowitz, who won the Nobel Prize for his work on portfolio theory, demonstrated that owning just 15 to 20 different stocks eliminates most company-specific risk. Adding bonds to a stock portfolio reduces volatility while maintaining solid long-term returns. The key insight is that you don't need perfect diversification to benefit from these protective effects. Starting small makes perfect sense. You might begin with a simple 3-fund portfolio containing domestic stocks, international stocks, and bonds. This basic structure provides instant diversification across thousands of companies and multiple asset classes. As your knowledge and wealth grow, you can add real estate investment trusts, commodity exposure, or emerging market stocks. But the foundation remains the same: spreading risk across different investments that respond differently to economic changes. Part 4. The Power of Patience, Long-Term Thinking for Peace of Mind. When Warren Buffett's Berkshire Hathaway lost 25% of its value in 2008, did he panic and sell everything? Absolutely not. Instead, he wrote his famous letter to shareholders explaining why patience, not panic, would determine their long-term success. This moment perfectly captures why the greatest investors view time as their most powerful ally. The mathematics of patience are striking. Jeremy Siegel's research in Stocks for the Long Run shows that while stocks can lose money in any given year, the probability of losing money over 20-year periods drops to near zero when you hold a diversified portfolio. This isn't just theory. Between 1926 and 2020, the S&P 500 had negative returns in about 26% of individual years, but never over any 20-year rolling period. Consider what happened to investors who stayed patient during the 2008 financial crisis. Those who maintained their diversified portfolios and continued contributing saw their investments fully recover by 2013. Meanwhile, investors who sold in panic locked in permanent losses. Fidelity conducted a study revealing that their best-performing accounts belonged to people who had either forgotten about their accounts or passed away. The lesson? Doing nothing often beats doing something. John Bogle built Vanguard on this principle. He frequently reminded investors that successful investing required the discipline to ignore market noise and trust in long-term trends. When the dot-com bubble burst in 2000, destroying trillions in wealth, investors holding diversified index funds experienced losses but recovered within 7 years. Those who chased individual tech stocks often never recovered their original investments. The compounding effect rewards patience exponentially. A $10,000 investment in a diversified portfolio earning 7% annually becomes $76,123 after 30 years. But here's the crucial part. Most of that growth happens in the final decade. This is why Benjamin Graham emphasized that successful investing requires the temperament to remain calm during inevitable market storms. Real estate investor Sam Zell built his fortune by taking 30-year views on property investments. He understood that real estate cycles could last decades, but patient investors who diversified across different property types and locations consistently built wealth. His approach demonstrates how patience applies beyond stock markets to all asset classes. The emotional benefits of patient investing extend beyond returns. Studies show that investors who check their portfolios daily experience higher stress levels and make more emotional decisions. Those who review portfolios quarterly or annually report greater satisfaction and achieve better long-term results. Peter Lynch, who managed Fidelity's Magellan Fund, discovered that his best stock picks often took 3 to 5 years to realize their full potential. He advocated for thinking like a business owner rather than a stock trader. This mindset shift transforms investing from a daily anxiety into a long-term wealth-building strategy. The power of patience, combined with diversification, creates a robust foundation for financial peace of mind. Time smooths out market volatility, allowing compound growth to work its magic, while reducing the emotional toll of short-term market movements. Chapter 2. Building Your Investment Story. Part 1. The 3-Fund Secret, Keeping It Simple and Smart. When Warren Buffett was asked what advice he'd give to the trustee managing money for his wife after he's gone, his answer shocked many Wall Street professionals. He recommended putting 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. No exotic derivatives, no hedge funds, no private equity, just 2 simple funds. The 3-fund portfolio takes this wisdom one step further by adding international diversification to the mix. Picture your investment portfolio as a 3-legged stool. One leg represents the entire U.S. stock market through a total stock market index fund. The second leg captures international markets through a global stock index fund. The third leg provides stability through bonds. This combination gives you ownership in thousands of companies across dozens of countries while maintaining remarkable simplicity. John Bogle, founder of Vanguard, spent decades proving that this approach beats the vast majority of complex investment strategies. His research showed that between 1970 and 2005, a simple 3-fund portfolio outperformed 80% of professionally managed funds. The reason? Lower costs, broader diversification, and elimination of human error. Consider Sarah, a 35-year-old teacher who started with a 3-fund portfolio in 2010. She allocated 60% to U.S. stocks, 20% to international stocks, and 20% to bonds. By 2023, her portfolio had grown consistently through multiple market crashes, including the 2020 pandemic sell-off. Meanwhile, her brother Mike jumped between dozens of individual stocks and trendy funds, constantly chasing performance. Despite spending hours researching investments, Mike's returns lagged behind Sarah's by nearly 3% annually. The beauty of the 3-fund approach lies in what it prevents. You avoid the temptation to chase hot sectors or time the market. You eliminate the paralysis that comes from choosing among thousands of investment options. Academic research from Burton Malkiel at Princeton demonstrates that adding more funds beyond this basic structure rarely improves returns, but often increases costs and complexity. When markets crashed in March 2020, 3-fund investors stayed the course while others panicked. The international component cushioned some volatility, bonds provided stability, and the broad market exposure captured the eventual recovery. This wasn't luck. It was systematic risk management through diversification. The three-fund portfolio works because it acknowledges a fundamental truth about investing. Predicting which companies, sectors, or countries will outperform is nearly impossible. Instead of trying to outsmart the market, you own it all. You capture the growth of human innovation and economic progress while sleeping peacefully at night. Sometimes the most sophisticated strategy is also the simplest one. Part 2. Beyond Stocks, Exploring Real Estate, Gold, and More. When Ray Kroc built McDonald's into a global empire, few people realized that his greatest wealth didn't come from hamburgers. It came from real estate. While investors focused on franchise fees and food sales, Kroc quietly accumulated one of the world's largest commercial real estate portfolios. His story illustrates a powerful truth. The most resilient wealth builders think beyond traditional investments. Real estate has historically provided protection against inflation that stocks and bonds cannot match. When prices rise across the economy, rental income typically increases alongside them. David Swensen, who managed Yale University's endowment for 3 decades, allocated roughly 15% to real estate investment trusts, REITs, and direct property ownership. During the 2008 financial crisis, while stocks plummeted 37%, many REITs held their ground better than expected, providing crucial stability when portfolios needed it most. Consider precious metals through the lens of Warren Buffett's teacher, Benjamin Graham. Graham viewed gold not as an investment, but as insurance, a hedge against currency debasement and financial system instability. When Turkey faced severe inflation in 2021, reaching over 80%, Turkish citizens who held gold preserved their purchasing power, while those relying solely on bank deposits saw their wealth evaporate. Gold doesn't produce income like stocks or bonds, but it has maintained value across civilizations for millennia. The legendary investor Paul Tudor Jones famously diversifies across assets most people never consider. His portfolio includes everything from agricultural commodities to vintage wines. During the COVID-19 pandemic, while traditional assets struggled, certain alternative investments thrived. Classic car values increased 13% in 2020. Fine art appreciated 7.5%, and even Pokémon cards became serious investment vehicles, with some rare cards selling for over $400,000. But here's where many investors stumble. They confuse complexity with sophistication. Alternative assets require genuine expertise and often come with high fees, illiquidity, and specialized knowledge requirements. Real estate demands understanding of local markets, maintenance costs, and tenant management. Commodities involve futures contracts and storage considerations that can quickly overwhelm novice investors. The practical approach involves starting small and learning gradually. REITs provide real estate exposure without property management headaches. Precious metals ETFs offer gold and silver exposure without storage concerns. These vehicles let you test alternative assets without the operational complexity of direct ownership. Research from Vanguard shows that adding small allocations to alternative assets, typically 5% to 20% of a portfolio, can reduce overall volatility without significantly impacting returns. The key lies in understanding that diversification across asset classes works differently than diversification within them. While stocks from different companies might fall together during market stress, real estate and precious metals often respond to completely different economic forces. Smart diversification means thinking like an insurance company, spreading risks across assets that respond differently to economic events. Your stock holdings capture economic growth, bonds provide stability, and alternatives offer protection against scenarios where traditional assets struggle. This approach transforms your portfolio from a collection of investments into a comprehensive wealth preservation system. Part 3. The Cost of Choices. How fees can eat your gains. When John's investment advisor called to congratulate him on his portfolio's 8% annual return, John felt pleased, until he discovered something disturbing in the fine print of his statements. After accounting for management fees, administrative costs, and trading expenses, his actual return dropped to just 5.2%. Those seemingly small percentages had quietly stolen nearly $15,000 from his $100,000 portfolio over 5 years. Most investors focus intensely on picking the right assets for diversification, but completely ignore the silent wealth destroyer lurking in every investment account: fees. While you carefully balance your portfolio across stocks, bonds, and alternative investments, these costs work around the clock, compounding against you with mathematical precision. Consider the real numbers behind fee erosion. A portfolio charging 1.5% in annual fees might seem reasonable, but over 30 years, this seemingly modest cost consumes roughly 35% of your total returns. Jack Bogle, founder of Vanguard, spent decades proving this point through rigorous analysis. His research showed that actively managed funds averaging 2.5% in annual costs delivered lower net returns than simple index funds charging 0.1% over virtually every extended time period. The mathematics become even more striking when applied to diversified portfolios. Imagine two identical investors, each starting with $50,000, split equally between domestic stocks, international stocks, and bonds. Investor A chooses low-cost index funds with a combined expense ratio of 0.2%. Investor B selects actively managed funds averaging 1.8% in fees. After 25 years, assuming identical gross returns of 7% annually, Investor A accumulates $271,264, while Investor B ends up with only $180,611. The fee difference alone costs Investor B over $90,000. What makes this particularly insidious is how fees compound negatively. Unlike your investment returns, which fluctuate with market conditions, fees extract their percentage every single year, regardless of performance. During market downturns, when your portfolio drops 15%, you still pay full fees on whatever remains. This creates a double penalty precisely when you can least afford it. The solution requires vigilance in fee comparison. Exchange-traded funds and index funds typically offer the most cost-effective diversification. Vanguard's Total Stock Market Index Fund charges just 0.03% annually, while Fidelity's equivalent charges zero fees for many index funds. These ultra-low costs mean virtually all your returns stay in your pocket rather than feeding fund management companies. Smart investors treat fee reduction as seriously as asset allocation. Before adding any investment to your diversified portfolio, calculate the total annual costs, including expense ratios, transaction fees, and any advisor commissions. Your future self will thank you for this discipline when those saved fees compound into substantial additional wealth over decades of patient investing. Part 4. Riding the Market Waves. Stay calm when storms come. When the dot-com bubble burst in 2000, technology investor Mark Cuban watched his paper wealth evaporate by hundreds of millions of dollars. Yet he survived because he had diversified beyond tech stocks into bonds, real estate, and cash positions. His story illustrates a fundamental truth about market volatility that every investor must grasp. Your brain is wired to sabotage your investment success. When markets plummet, the same fight-or-flight response that helped our ancestors survive predator attacks now triggers panic selling at precisely the worst moment. During the 2008 financial crisis, research from Dalbar Inc. found that the average investor earned just 1.9% annually, while the S&P 500 returned 8.4% over the same period. The difference? Emotional decision-making during turbulent times. Consider the experience of Vanguard investors during March 2020. As COVID-19 fears sent markets into freefall, diversified portfolios containing both stocks and bonds cushioned the blow. While the S&P 500 crashed 34% from its February peak, balanced portfolios with 60% stocks and 40% bonds fell only 19%. More importantly, investors who maintained their diversified positions recovered their losses within 5 months. Those who panicked and sold missed the entire recovery. The psychological trap runs deeper than simple fear. FOMO drives equally destructive behavior during bull markets. When GameStop shares rocketed 1,500% in early 2021, countless investors abandoned their diversified strategies to chase the meme stock frenzy. Most arrived after the peak and suffered devastating losses. Reddit user testimonials documented six-figure retirement account wipeouts from concentrated bets gone wrong. Your diversified portfolio acts like a financial shock absorber. When growth stocks crater, value stocks or international holdings may hold steady. When inflation surges, commodities and real estate often provide protection. During the stagflation of the 1970s, investors who owned precious metals and real estate alongside stocks maintained purchasing power, while those concentrated in growth stocks lost decades of progress. The remedy requires both strategy and psychology. First, automate your investments through dollar-cost averaging to remove emotion from timing decisions. Second, review your portfolio only quarterly, not daily. Behavioral finance research shows that frequent monitoring increases stress and poor decision-making. Third, write down your investment plan during calm periods and refer to it during storms. Warren Buffett's teacher, Benjamin Graham, offered the most powerful mental framework. He described market volatility as Mr. Market, an emotionally unstable business partner who offers to buy or sell shares at wildly fluctuating prices. Sometimes he's irrationally optimistic, other times deeply pessimistic. Your job is to ignore his mood swings and focus on the underlying value of your diversified holdings. The most successful investors treat market volatility as background noise, while their diversified portfolios quietly compound wealth. They understand that temporary losses are the price of admission for long-term gains, and that staying the course during storms separates wealth builders from wealth destroyers. Chapter 3: The Art of Risk and Reward. Part 1: Knowing Your Comfort Zone, the Balance of Fear and Opportunity. When John Paulson bet against subprime mortgages in 2007, he made billions. When he later concentrated heavily in gold mining stocks and pharmaceutical ventures, he lost billions. The difference wasn't intelligence or market timing. It was understanding his own relationship with risk and how diversification could work for or against him. Your comfort zone with money isn't just about numbers on a statement. It's about how you sleep at night when markets drop, whether you panic sell during crashes or if you can stick to a plan when everyone else is running for the exits. Benjamin Graham, the father of value investing, understood this psychological reality when he wrote about the margin of safety, not just as a financial concept, but as an emotional buffer that lets investors think clearly during turbulent times. Consider the tale of two teachers from California during the dot-com bubble. Sarah invested her retirement savings entirely in technology stocks because the returns looked incredible. Tom spread his money across stock index funds, bonds, and international markets. When the bubble burst in 2000, Sarah lost 80% of her portfolio and had to delay retirement by a decade. Tom's diversified portfolio dropped only 15%, and he recovered within 2 years. The key insight? Sarah thought she had a high risk tolerance because she was making money. But real risk tolerance reveals itself during losses, not gains. True comfort with risk means you can watch your portfolio decline 20% without losing sleep or making emotional decisions that damage your long-term goals. John Bogle, founder of Vanguard, discovered this principle through decades of watching investor behavior. He observed that people who claimed they wanted aggressive growth would often sell everything during market downturns, locking in losses at exactly the wrong moment. Those who built properly diversified portfolios matched to their actual emotional limits, stayed invested, and captured the market's eventual recovery. Think of risk tolerance like physical fitness. You might believe you can run a marathon, but your true fitness level only emerges when you're actually running mile 20. Similarly, your comfort with investment risk only becomes clear when markets are crashing and your portfolio is bleeding red. The research from the Millionaire next door supports this wisdom. Wealthy individuals rarely got rich through dramatic, high-risk bets. Instead, they built diversified portfolios that match their psychological makeup, allowing them to invest consistently over decades without emotional interference. Your comfort zone isn't a weakness to overcome. It's valuable information for building a portfolio you can actually stick with. A moderate portfolio you maintain for 30 years will almost always outperform an aggressive portfolio you abandon after the first major downturn. The goal isn't to maximize theoretical returns, but to find the sweet spot where opportunity meets your emotional reality. Part 2. Safe Havens. Protecting your wealth when markets crash. When Ray Dalio's Bridgewater Associates lost $12 billion in 2022, the world's largest hedge fund still protected its investors better than most portfolios. The secret wasn't avoiding losses entirely. That's impossible. Instead, Dalio had built multiple layers of protection that cushioned the blow when markets turned violent. Think of safe havens as financial insurance policies you hope never to need but are grateful to have when disaster strikes. During the 2008 financial crisis, while the S&P 500 plummeted 57%, investors holding treasury bonds actually made money. Those who owned gold saw it climb 25% as everything else collapsed. This isn't about timing markets or predicting crashes. It's about building defenses before you need them. The most reliable safe haven remains government bonds, particularly U.S. Treasuries. When Lehman Brothers collapsed in September 2008, panicked investors flooded into Treasury bonds, driving yields to historic lows. A portfolio with 40% bonds lost far less than one with 100% stocks. Benjamin Graham understood this principle decades earlier, advocating for bond allocations that provide stability when equity markets lose their minds. Cash often gets dismissed as earning nothing. But during the dot-com crash of 2000 to 2002, cash was king. While tech stocks lost 78% of their value, investors with cash reserves could buy quality companies at fire sale prices. Warren Buffett famously held $137 billion in cash before the 2020 pandemic, allowing Berkshire Hathaway to make strategic acquisitions when others were desperate for liquidity. Gold presents a more complex picture. During the 1970s stagflation, gold soared from $35 to $850 per ounce, while stocks stagnated. Yet from 1980 to 2000, gold lost money in real terms while stocks boomed. The lesson isn't that gold is perfect protection. It's that diversified safe havens work better than any single asset. Modern safe haven strategies extend beyond traditional assets. Real estate investment trusts, REITs, provided protection during the early 2000s recession, while international bonds offered currency diversification during dollar weakness. Some investors even hold cash in multiple currencies, remembering how Swiss francs protected wealth during various European crises. The key insight from Burton Malkiel's research is that safe havens work through non-correlation, not absolute safety. When stocks zig, bonds often zag. When inflation rises, real assets like commodities may shine while financial assets struggle. No single asset protects against every scenario, but a thoughtful combination creates multiple insurance policies. The practical approach means holding 20 to 40% of your portfolio in various safe havens, treasury bonds, cash reserves, perhaps some gold or international exposure. During calm periods, this drag on returns feels frustrating. But when markets crash, and they always do eventually, these assets become your financial lifeline. As John Bogle observed, it's better to own protection you don't need than to need protection you don't own. Part 3. Mind over Money: Psychological Tricks of Successful Investors. When Warren Buffett's Berkshire Hathaway lost nearly half its value during the 2008 financial crisis, the Oracle of Omaha didn't panic sell or abandon his strategy. Instead, he continued his methodical approach, demonstrating that even legendary investors must master their emotions to succeed. Your mind, it turns out, may be your portfolio's greatest enemy or its most powerful ally. Charlie Munger once said that investing is simple, but not easy. The simple part involves buying good companies at reasonable prices and holding them. The difficult part is controlling yourself. Research from behavioral finance pioneer Daniel Kahneman shows that our brains are wired with cognitive biases that consistently lead to poor investment decisions. We feel losses twice as intensely as equivalent gains, causing us to sell winners too early and hold losers too long. We chase recent performance, piling into hot sectors just before they crash. Consider the dot-com bubble of 2000. Ordinary investors, intoxicated by stories of instant millionaires, abandoned diversified portfolios to chase technology stocks. When the bubble burst, those who had concentrated their holdings lost 80% or more. Meanwhile, investors who maintained diversified portfolios across asset classes, including boring value stocks and bonds, recovered much faster. The difference wasn't intelligence or market timing, it was emotional discipline. Peter Lynch, who managed Fidelity's Magellan Fund to legendary returns, developed a simple rule. He would write down his investment thesis for each stock purchase. When emotions ran high during market volatility, he could refer back to his original reasoning. This technique works because it separates the logical decision-making process from the emotional moment of market stress. Benjamin Graham taught that successful investing requires treating your emotions like a manic-depressive partner named Mr. Market. Some days he offers to buy your investments at ridiculously high prices. Other days, he wants to sell at absurdly low prices. The key is responding rationally rather than matching his mood swings. Practical techniques can help manage these psychological traps. Automatic investing removes the daily decision-making that leads to emotional errors. When you set up systematic monthly investments, you buy more shares when prices are low and fewer when prices are high. Dollar-cost averaging that works with human nature rather than against it. Portfolio rebalancing provides another emotional anchor. By setting specific percentages for different asset classes and rebalancing quarterly, you force yourself to sell what's performed well and buy what's lagged behind. This systematic approach contradicts every emotional instinct but consistently improves returns. Ray Dalio, founder of Bridgewater Associates, credits meditation with improving his investment decision-making. By developing awareness of his emotional states, he learned to recognize when fear or greed was influencing his judgment. The practice helped him maintain the mental clarity necessary to stick with diversified strategies during turbulent periods. Your diversified portfolio is only as strong as your ability to maintain it during crisis. The investors who succeed long-term develop systematic approaches that remove emotion from critical decisions, allowing rational strategy to prevail when markets test their resolve. Part 4. Diversification in Action: Stories of Wins and Lessons Learned. When Warren Buffett's Berkshire Hathaway lost 50% of its value during the dot-com crash, even the Oracle of Omaha learned that diversification extends beyond simply owning multiple stocks. His concentrated betting strategy, which had worked for decades, suddenly faced its greatest test. The lesson was clear. Even legendary investors need protection from unexpected market forces. Consider the story of Sarah Chen, a software engineer at Enron who kept 70% of her retirement savings in company stock. When Enron collapsed in 2001, she lost nearly everything at age 58. Meanwhile, her colleague David Martinez had diversified across international funds, bonds, and real estate investment trusts. While David's portfolio dropped 15% during the crisis, Sarah faced financial ruin. This stark contrast illustrates how diversification transforms potential disasters into manageable setbacks. The 2008 financial crisis provided perhaps the clearest demonstration of diversification's protective power. Yale University's endowment, managed by David Swensen, weathered the storm better than most institutional investors. Swensen had spread investments across asset classes that many considered exotic: timber, commodities, and emerging market bonds. While traditional stock-heavy portfolios plummeted 40%, Yale's diversified approach limited losses to 25%. Harry Markowitz, who won the Nobel Prize for modern portfolio theory, practiced what he preached in his personal investing. During the 1970s stagflation period, when both stocks and bonds suffered simultaneously, Markowitz's allocation to real estate and international securities helped preserve his wealth. He later admitted that without this diversification, his family's financial security would have been seriously compromised. The dot-com bubble offers another compelling example. Technology-focused investors, like those holding the QQQ index fund, watched their investments fall 78% from peak to trough. However, investors following the simple three-fund portfolio approach recommended by Bogleheads saw much smaller losses. Their combination of total stock market, international, and bond funds provided crucial stability when growth stocks collapsed. Regular rebalancing proved essential during these crises. Jim Rogers, despite being famous for commodity investing, maintained positions in currencies and international markets. During the 2008 crash, his diversified approach across geographies and asset classes helped him avoid the concentrated losses that devastated single-market investors. These stories reveal a fundamental truth. Diversification isn't about eliminating risk entirely, but about ensuring that no single investment decision can derail your financial future. The investors who survived major market disruptions weren't necessarily the smartest or most sophisticated. They were simply the ones who refused to put all their eggs in one basket. Each crisis teaches the same lesson differently. Diversification transforms investing from a high-stakes gamble into a manageable long-term strategy. The question isn't whether markets will crash again, but whether your portfolio can survive when they do. Chapter 4: The Millionaire's Path, Part 1: Habits of Wealth. How smart savers think differently. When researchers Thomas Stanley and William Danko spent decades studying America's wealthy, they discovered something that shattered popular assumptions about millionaires. These weren't flashy spenders driving luxury cars or living in mansions. Instead, 80% of millionaires were first-generation wealthy, ordinary people who built their fortunes through surprisingly mundane habits that anyone could adopt. The typical millionaire drives a 3-year-old Toyota, shops at discount stores, and has never owned a Rolex. Stanley's research revealed that most wealthy individuals spend less than $400 on a watch and buy their cars used. This isn't about deprivation. It's about understanding that every dollar saved and invested compounds over decades into substantial wealth. Consider the story of Earl Crawley, a janitor from Vermont who accumulated over $6 million by the time he retired. Crawley never earned more than $18,000 annually, yet he consistently saved 40% of his income and invested in diversified mutual funds. His secret wasn't exceptional returns or hot stock tips. It was the boring discipline of living below his means and letting compound interest work its magic. Benjamin Graham identified this pattern long before Stanley's research. In The Intelligent Investor, Graham observed that successful investors share 3 critical traits. They spend less than they earn, they invest the difference consistently, and they diversify to protect their capital. This isn't glamorous, but it works with mathematical certainty. The wealthy think differently about risk. While most people chase the next big investment opportunity, millionaires focus on not losing money. They understand what Graham called the margin of safety, the buffer that diversification provides against market volatility. Warren Buffett's mentor knew that protecting capital matters more than hitting home runs. John Bogle's research at Vanguard confirmed this approach. He found that investors who contributed regularly to diversified portfolios over 30 years consistently outperformed those who tried to time markets or pick individual stocks. The boring strategy won because it eliminated emotional decision-making and reduced costs. Wealthy individuals also share an obsession with learning. They read financial publications, understand their investments, and make informed decisions rather than following crowd psychology. This knowledge helps them stay calm during market downturns and continue investing when others panic, precisely when diversified portfolios offer the best future returns. The connection between these habits and diversification isn't coincidental. Diversification supports the millionaire mindset perfectly. It provides steady, predictable growth without requiring constant attention or expertise in individual companies. This reliability allows wealthy individuals to focus on their careers and businesses while their investments grow quietly in the background. Perhaps most importantly, wealthy people automate their success. They set up systems that make saving and investing automatic, removing willpower from the equation. This systematic approach, combined with diversified portfolios, creates a wealth-building machine that operates independently of emotions or market timing, the foundation upon which ordinary people build extraordinary financial security. Part 2. The Cash Flow Connection. Investing beyond the obvious. Most investors chase stock prices like sports fans watching scoreboards, missing the real game happening right underneath their noses. While headlines scream about Tesla's latest surge or Bitcoin's wild ride, quietly successful investors collect something far more valuable: steady streams of cash flowing into their accounts month after month, year after year. Robert Kiyosaki transformed how millions think about money when he shared his Rich Dad's wisdom about cash flow in his best-selling book. The Rich Dad understood something the Poor Dad didn't. Assets should put money in your pocket regularly, not just appreciate on paper. This isn't just motivational speaking. It's mathematical reality backed by decades of wealth-building evidence. Consider dividend-paying stocks like Johnson & Johnson, which has increased its dividend for 61 consecutive years. Even during the 2008 financial crisis, when stock prices plummeted, J&J shareholders received their quarterly checks. Meanwhile, growth stock investors watched their paper wealth evaporate overnight. This illustrates why Benjamin Graham, the legendary investor who mentored Warren Buffett, emphasized income-producing securities as essential portfolio components. Real estate investment trusts offer another powerful example. REITs must distribute 90% of their taxable income to shareholders, creating predictable income streams. During 2020's market volatility, many REIT investors received monthly distributions while their neighbors worried about job security. This cash provided options: reinvest for compound growth, cover living expenses, or seize opportunities when others faced financial pressure. Bond ladders create yet another income stream. By purchasing bonds with staggered maturity dates, investors receive regular interest payments, plus principal repayments over time. Corporate bonds from stable companies like Microsoft currently yield around 4 to 5%, providing steady income regardless of stock market gyrations. The magic happens through reinvestment. John Bogle's research at Vanguard showed that reinvesting dividends contributed roughly 40% of stock market returns over long periods. Each dividend payment purchases additional shares, which generate more dividends, creating a compounding effect that accelerates wealth building. Diversifying across multiple income streams reduces dependency risk. If one source falters, perhaps a company cuts its dividend, others continue flowing. This approach requires thinking differently about investments. Instead of asking, "Will this stock price increase?" ask, "How much monthly income will this generate?" Building cash flow portfolios demands patience over quick profits. However, the psychological benefits prove enormous. Regular income reduces anxiety during market downturns Because your investments actively work for you regardless of daily price movements. This steady cash flow foundation allows for more aggressive growth investments elsewhere, knowing your basic income needs remain covered. The wealthiest individuals often maintain significant portions of their portfolios in income-producing assets. Understanding that consistent cash flow provides both financial security and strategic flexibility that pure growth investments cannot match. Part 3. Growing your garden. How small steps lead to big rewards. When Charlie Schwab started with just $5,000 in 1971, few believed his discount brokerage would revolutionize investing for ordinary Americans. Yet his success stemmed from a simple truth. Wealth grows not through dramatic gestures, but through consistent nurturing of small contributions. Like tending a garden, building wealth requires patience, regular care, and trust in natural growth processes. Consider the story of Grace Groner, a secretary who worked for Abbott Laboratories for 43 years. She bought 3 shares of company stock in 1935 for $60 and reinvested every dividend. When she died in 2010, her estate was worth $7 million. Groner never earned a 6-figure salary or made spectacular trades. She simply planted seeds and let time work its magic. The mathematics behind this approach prove compelling. A $200 monthly investment earning 8% annually grows to approximately $700,000 over 30 years. That same amount reaches $1.5 million over 40 years. The difference between moderate wealth and significant prosperity often comes down to starting earlier and staying consistent rather than investing larger amounts later. Warren Buffett famously compared compound interest to a snowball rolling downhill, gathering size and momentum. Early contributions benefit from decades of growth, while later additions have less time to compound. A 25-year-old investing $100 monthly will accumulate more wealth by retirement than a 35-year-old investing $200 monthly, assuming identical returns. This principle explains why Ann Scheiber, a retired IRS auditor living modestly in New York, accumulated $22 million by her death in 1995. Starting with $5,000 in 1944, she invested in blue-chip stocks and reinvested dividends for 51 years. Her secret was not picking winning stocks, but staying invested and letting dividends compound. Diversification amplifies these benefits by reducing the risk that any single poor investment derails your progress. Thomas Stanley's research in The Millionaire Next Door revealed that most millionaires built wealth through steady investing in diversified portfolios rather than concentrated bets. They understood that consistent modest gains beat sporadic large wins followed by devastating losses. Modern investors can apply this wisdom through simple strategies. Dollar-cost averaging into diversified index funds removes timing concerns while capturing broad market returns. When markets decline, your fixed investment buys more shares. When markets rise, your existing shares benefit. The key lies in viewing each contribution as planting seeds in fertile soil. Some years bring abundant harvests. Others require weathering storms. But patient gardeners who tend their plots consistently, diversifying across different crops and seasons, ultimately reap the greatest rewards. Your financial garden grows strongest when you focus on regular planting rather than predicting weather patterns. Part 4. Your own investment journey. Creating a personalized plan. When Sarah Chen opened her laptop one evening in 2019, she faced a paralyzing decision that millions of investors confront daily. With $50,000 saved and conflicting advice swirling in her head, she wondered, how do you actually build a plan that works for your specific life? Research from Vanguard shows that 80% of individual investors fail to create written investment plans. Yet those who do earn 3% more annually on average. Creating your personalized investment strategy starts with honest self-reflection, not market predictions. Sarah began by writing down 3 simple questions. What do I need this money for? When will I need it? How would I feel if it dropped 30% tomorrow? Her answers revealed a 25-year timeline for retirement, moderate risk tolerance, and a desire for steady growth over quick wins. This clarity became her foundation. The most successful investors, according to Thomas Stanley's research in the Millionaire Next Door, share one trait. They know their numbers. Calculate your monthly income, expenses, and realistic savings capacity. If you can invest $500 monthly, that becomes your starting point. Don't wait for a perfect amount or ideal market conditions. Charles Schwab's 2021 study found that consistent investing over 20 years, regardless of market timing, produced positive returns in 100% of cases. Your asset allocation should reflect your timeline and temperament, not magazine headlines. A simple 3-fund approach works for most people: Total Stock Market Index, International Stock Index, and Bond Index. Sarah allocated 70% stocks, 20% international, and 10% bonds at age 30. As John Bogle demonstrated through decades of research, this diversified foundation captures market returns while managing risk better than complex strategies. Building multiple income streams within your portfolio creates additional stability. Beyond growth-focused investments, consider dividend-paying stocks or REITs for steady cash flow. Robert Kiyosaki's emphasis on cash-generating assets makes practical sense. Income-producing investments provide options during market downturns and reduce dependence on selling shares. Your plan must evolve with life changes. Sarah's original allocation shifted when she married, bought a house, and had children. She increased bond allocation to 20% by age 40 and added international exposure. The key lies in scheduled reviews, not emotional reactions to market news. Set calendar reminders quarterly to rebalance if any asset class deviates more than 5% from targets. Start today with whatever amount you have. Sarah began with $200 monthly contributions to a target date fund before learning about individual index funds. Perfection paralyzes progress. Your first investment teaches you more than months of research. Open an account, make that initial contribution, and begin your journey. The compound growth you miss while waiting costs far more than any minor optimization you might discover later. Your investment plan succeeds through consistency, not complexity. Write down your goals, choose simple, diversified investments, automate contributions, and review periodically. Trust the process, ignore market noise, and let time work in your favor.